Scott, it's a call that's looking really tenuous, but we still think the lows for the first half are in, maybe even the lows for the year. And it's not because the news has been great, as you're pointing out. Things have been really grim. The Fed's quite hawkish. We've got some bad inflationary data. But the confidence we have about the lows being in really reflects what we think is pretty extreme positioning by institutional investors. I think institutional investors have really positioned for a pretty deep contraction. The latest JP Morgan prime brokerage data shows it's where it was in like April 2020. So if the news becomes less bad, or if the news tracks what people expect, we're actually going to expect investors to re-risk, which means the stock market kind of has a general underlying bid by hedge funds.
But Tom, you put out a new note today, and one of the key principles that gave you some comfort was that the S&P 500 was above its 200-day moving average. I'm not sure if you've seen how the numbers have settled out, but in the here and now, we're back below the 200-day moving average, and we've closed below the 200-day moving average. That cannot be a good sign.
Scott, that's not a good sign. 4490 is a 200-day, and generally we want the index to be above the 200-day because it's in an uptrend. So you're right, it's in a moment of indecision. However, I would just caution, the index was over 8% below its 200-day and then recovered its 200-day. And since 1942, since World War II, in the non-recession years, 90% of the time the stock market was higher 6 months later. So it's a pretty important signal that we actually made a huge move below 8% to 200-day and then recovered. So it's not pretty today, but I still think that we still generate a lot of signal by making that recovery.
All right, so Josh Brown, I want you to react to a tweet from Jim Cramer just a short time ago in which he says, quote, "We're seeing two markets. The non-tech market is out of the bear's grip and can be bought. The tech market soon enough. I like the inexpensive non-tech stock portion very, very much. The bear market in that group has run its course, and these stocks are headed to highs." What exactly is he referring to? What do you think about what the point that he makes here?
Well, without a doubt, there are many, many, many stocks acting better than tech stocks. I don't know that there's anything particularly profound about the fact that we have dispersion in this market. I could look at biotechs, for example, barely red. Those are supposed to be speculative stocks, but I think people understand they're down an average of 30 or 40% from their highs, and the science that they're pursuing is completely unaffected by the macroeconomy or the Fed. So, that's an area where if you're a growth manager and you say, okay, what's going to grow if the Fed slows the economy? Look toward mid-cap and large-cap biotech. That's reasonable to me. If you're worried about inflation, look at high dividend-paying oil companies that are about to report record profits. That's reasonable. Utilities look good. So I don't think we're saying anything special. Big picture, I come on here every week since January. I continue to give people what I think is the most reasonable playbook. You can't get too bearish because in the end, the best cure for the inflation blues is the growth you get from corporate earnings, dividends, and the U.S. stock market. But anytime you see that VIX tick below 20, which I think is the new bottom of the range for the regime that we're in since coronavirus started 2 years ago. And so we saw a 19 VIX on Monday. That was it. Start calming down. Start taking things off if you're a trader. Don't overstay your welcome. We had a nice run. Now the VIX is spiking once again. Back toward 28, 29, 30. Don't stay too bearish. There are buyable stocks at those VIX levels. That's when people get too bared up. And I agree with Tom. A lot of what's going on now is positioning. The only thing I want to say about positioning, and the only problem with that idea, is that it's not quite what it used to be. Meaning, yes, people might be getting risk off in the stock market, but keep in mind how much risk they're taking in private equity that they weren't taking years ago. It's like $5 trillion in PE funds. Look at venture capital. Crypto is $2 trillion. So there are a lot of risks that are being taken by institutions that are not stock market risk. So I don't know that we could still rely on how bullish or bearish positioning is based on the old metrics from a prior time. I'd love to hear what Tom's take is on that.
Well, let me ask you this first, because Jim's clearly speaking of defensive stocks, which have remained strong, as you said, utilities and the staples. And you make an interesting comment. I come on here since the beginning of the year and we talk about the playbook. And I wonder if yesterday's playbook works today, given what Brainerd had to say, what Dudley wrote. They basically said the Fed is not your friend. In fact, it's not even close to your friend. It's your adversary. And they want stocks to go down, and they're going to make stocks to go down.
That's wrong. That's wrong. That's wrong. I'll tell you why that's wrong. The Fed is your friend. They're doing this for a reason. It's not good for the economy and ultimately for earnings to let this run wild. The Fed is your friend. The nonsense has to stop. The nonsense. The trading of digital JPEGs amongst people who don't have a job. It's got to stop. 19% year-over-year increases in home prices. Did you read Barron's this weekend? They think 2 million people are going to be locked out of the housing market this year because of unreasonable costs. The Fed is your friend. The nonsense has to stop. We did an extra year of stimulus that was way unnecessary, and that's what's being unwound now, and it's going to be a better entry point for investors once we clear the decks.
Tom, the nonsense has to stop. It's going to stop one way or the other, and Bill Dudley lays it out clearly today. It's going to stop because the Fed's going to stop it. And he says, and I quote, if stocks don't fall, the Fed needs to force them. One thing is certain, to be effective, the Fed will have to inflict more losses on stock and bond investors than it has so far. Investors should pay close attention to what Powell has said, right? Josh is right. Is it good in the end? Of course. Is it going to be painful as heck if the Fed has to do what Dudley suggests it does? You bet it will be. And I wonder if you're ignoring those risks to the stock market, which the Fed is screaming at you, and the stock market seems to be, at least part of it, snoring.
Yeah, I would say that the Fed communication is 80% of their policy, so nobody should ignore what the Fed's saying. I think, in a way, it ties into what Josh is saying, which is there is a pretty large adjustment taking place in valuation of assets, not just public equities, but it's really privates and venture that need to be marked down. They're really going to be affected by tightening financial conditions because a lot of these, one, didn't have any marks, but also their access to capital isn't as liquid as large cap publicly traded companies. The tech sector, which is kind of linked to all this, has already made a huge correction. I mean, down 24%. I mean, that's already a bear market. So to an extent, I don't know when you hear about Fed policymakers and jawboning and communicating, and I think really trying to calibrate market expectations, I don't necessarily think that means the S&P has to itself make a visit down to 3,500, because there's no level here where the S&P gets to that cures inflation. It's really a process of calibrating market expectations around inflation and then actually having delivered inflation lower. So I think we're in a dead zone. I think that ties into a treacherous first half. But I also think that 4,000 on the S&P, which was the February 24th low, is a pretty important level because that was pricing in 2/3 of the chance of recession. So I don't think that we get back to that level.
So, Josh, what am I supposed to do if I'm an investor in technology today? And I witnessed the last couple of days, and Brainerd really started the waterfall. Maybe Dudley poured some on it, and then the minutes today certainly suggest that the amount of QT is going to be a bit stronger than the market initially thought. In the last couple of days, for example, I've got Snowflake down 11%, Salesforce down 8%, Palantir down 10%, DocuSign down 8%. I mean, I can go down the list, even to the big caps, Microsoft and Apple and Google and Amazon and NVIDIA, given some decent amounts back over the last couple of days. What do I do with those today?
I think most investors are positioned in such a way that they can weather what's already to Tom's point, a lot of this damage has already taken place. We're just revisiting levels that we saw at the end of February. We're not necessarily carving out new lows in the tech large caps. And I think most investors are not overexposed. Bear in mind, there are substantial losses taking place all over the world, but in places like, for example, SoftBank North Star Fund, or some of the Tiger Cubs that became crossover investors, those are big boys. They can weather that. They will be fine. They'll all be billionaires tomorrow. Most investors right now have to focus on a couple of things. Number one, liquidity. Are you invested in such a way that if you need to get access to money, you can? If that's going to be an issue with the way your portfolio is set up, on the next massive rally, do something about it. Are you diversified? Is any one sector going to make or break your life? I know a lot of young people are like 80% tech and consumer discretionary. You have an opportunity now. Fix that. There are other places to be invested that are non-correlated with the growth trade, to Jim Cramer's point. So you have a playbook that you can make moves today when you want to, before you have to, and it's too late.
Great points you make. Should I, to expand on Cramer's point and yours, should I continue to ride what he calls an outrageous bull market in consumer packaged goods and drug stocks? Should I continue to play that? Is that the winner in the environment in which we describe?
I think the tragic answer that I have to give you, and the very intellectually honest answer, is that if in fact we're still in the grips of this bear market that I think started probably sometime around November, if we're still there, and the evidence says we are, the lack of new highs is the tell, eventually they're going to get to everything. We are already anecdotally hearing stories about consumers trading down from craft to generic brands in the supermarkets, not because it's a full-blown recession and they're worried about their jobs. In fact, it's the opposite. Their wages are not keeping pace with the cost of things. So even in an inflationary environment, you would have to worry about the staples, because they're not going to keep those margins, and they're not going to keep the consumer pulling their products off the shelf where cheaper alternatives lie. And the best example of that, look at the divergence between Walmart and Target, or Costco and Target. What do you think is happening there? Walmart and Costco are consumer staples. Target is consumer discretionary. That's why those stocks are being treated differently. Think about the mindset of the consumer. 20 to 40% of consumers are looking for ways to cut back on costs. And that's at full employment, okay? So the staples ain't gonna save you.
Well, what I don't quite understand, Tom, from your point of view is, don't fight the Fed. We say it every time. We've been saying it since '09. Don't fight the Fed on the way up. So why are we trying to fight it and be cute, potentially, on the way down, right? Sam Zell said it last hour. There's no substitute for liquidity. The liquidity is being taken away. If liquidity gets you way up on the top of the wave, if you pull it away, the wave crashes. It doesn't seem to be any more difficult than that. Why is it?
That's right, Scott. You're right. I think it can come across that we're trying to be to weave too narrow a line. I mean, we still think the first half is treacherous for all the reasons that we've discussed, and the S&P below its 200-day isn't a positive development. But I think that February 24th is still a key level to watch, because that was S&P 4000. That's what we think is the low for the year because of what it discounted at that time. And again, I think you're absolutely right, and I think everybody who's watching this should understand the Fed is not dovish. They're trying to adjust and really communicate to the markets, but it doesn't mean every stock is dangerous. And even Jim's point and Josh's point, energy's held up really well. I think some of the defensives are certainly doing quite well, but even large cap tech, I think, is really now at a point where seasonally it actually gets kind of attractive. So I think a lot of bad news is priced in. But yes, this doesn't mean stocks go up and to the right. I think we're in a really tough zone, but I'm still a net buyer of stocks here.
Okay, let's welcome in our senior economics reporter, Steve Leisman. I want him to join the conversation. What I want to know from you first and foremost, Steve, is how much has really changed for investors over the last 48 hours, from Brainerd to the minutes, Dudley, and everything combined?
It depends a bit on how much they were paying attention, Scott, right? If they were not paying attention to what's largely been out there on the Fed balance sheet reduction, it may seem like the Fed went from 0 to 95 billion overnight. But for those who were paying attention, our survey showed somewhere between 75 and 85 billion. This is marginally more aggressive. It's a quicker ramp up to the full number, 95 billion. So it's a little bit more aggressive. And then you're going to combine that with the new idea, which is out in the last couple of weeks and affirmed in the minutes today, that they're probably going to do one or more 50 basis points. So we're probably looking at, I'm having a back and forth with Barry Knapp on this, Scott, as to whether or not this is equal to, more aggressive or less aggressive than 1994. But it's around that kind of magnitude of the 1994. And by the way, we survived that. It wasn't pleasant or pretty in the bond market, but we survived it. We went through it. And the question is whether or not that's enough to get a hold of inflation here.
Does the fact that it's more aggressive, and I think we can all agree that it is, does that in and of itself underscore the doubt in the room from the Fed that they can pull this off? And they need to get a handle on it, and they need to do it now.
You know, we talked about that last week, Scott, what the Fed itself is saying about the outlook here, that they say, yet Esther George say, a soft landing is possible but not guaranteed. You had Fed Chair Jay Powell saying that a soft landing, there was some possibility of it happening. I'm not sure that a soft landing is actually in their forecast, but I think what the Fed wants you to understand here is they're willing to do the hard landing in order to get control of inflation. And there are some people out there, there's Larry Summers, for example, who feel that's exactly what the Fed will have to do, is to slow the economy down below potential growth, down below zero, and contract the economy in order to get a hold of inflation. I think it remains to be seen. The Fed could get some help from the fiscal side, supply chain stuff, bringing people back into the workforce, some demand destruction from higher prices. All that stuff could give the Fed a little bit of a hand here, but there are those who think you've got to raise the funds rate above at least above negative, where it is right now on an inflation-adjusted basis. So that could mean a 3 or 4% rate. Right now, the market has 200 additional basis points, call it 240, 245 for December this year, and then up towards 3% for next year.
You know, Josh, of all of the important things that Mr. Leisman just said, I think the most important one is they're willing to do the hard landing. They're willing to. They're willing to rip the Band-Aid off. They have no choice. And that hard landing means that stocks are not where they are today. And they are potentially a lot lower than where they are today. And they're trying to get that message across. And some investors don't want to listen to it.
Yeah, the market is now pricing in 250 basis points approximately worth of Fed action this year. We learned that the Fed was willing to go 50 basis points in March and would have if not for the invasion of Ukraine just a week and a half prior. That's like meaningful because it backs up what Steve is saying. I hear a lot of people come on and talk about buying opportunities, and yes, there are currently and will continue to be, but to have this overall market view that everything's fine because of valuations or whatever, you really should be nowhere near a Bloomberg terminal if that's how you're looking at this. Technicals are what are going to tell you what's going on and what the probabilities are of what's about to happen next. So if you're running any sort of tactical asset allocation right now, or your advisor is or whatever, make sure it's based on price action and not things that don't matter in a moment where the Fed could conceivably do 3 straight months of 50 basis point hikes, because no amount of press conferences are going to change the fact that that is a substantial difference in the liquidity situation from where we were just 3 months ago.
Steve, be real quick, and then I'm going to give Tom Lee the quick last word. Is there any scenario in which the Fed goes a full point?
I don't think so, no. And I want to push back a little bit on Josh here. Josh, you're right. It's taking liquidity out of the market, but that doesn't mean we're necessarily going to have a liquidity crunch here. You're going to take liquidity away from some people who don't deserve it, and are going to be crunched by that. I'm just making a distinction here, Josh, between the idea that we don't at the moment have a taper tantrum, and we don't have a liquidity problem inside the bond market. We could get there, and that could cause the Fed to pause. But right now, we have losses, we have higher yields, we don't have a liquidity crunch. I want to make that short-term versus longer-term distinction.
I got you. Rest the pipes. We're going to see it on Fast Money in just a little bit, Leisman. I appreciate it very much.
Thanks.
I know you hustled to make this work, and we do appreciate that in overtime. Tom Lee, quick, last word.
Well, I think it's, again, a really tricky time for investors, but it's important to have a view both long-term and short-term. And I mean, I agree. I think it's a very tricky period. I still think February 2024 are the lows for the first half, maybe for the year. But again, it's not smooth sailing in the first half.